Hello and welcome to the latest Moneymakers Investment Trust podcast with me, Jonathan Davis. A reminder that for regulatory reasons, nothing you hear today, however stimulating and insightful, should be regarded as constituting individual investment advice. This week I had the chance to talk to Alan Gauld, who is the lead manager for Patria Private Equity Trust. You may know this better as formerly Aberdeen's listed private equity trust. Last year, they completed this change where it was effectively sold to Patria, which is a large private equity manager based in Brazil, but also listed on NASDAQ in the States. So, Alan, listed private equity in the UK has been very much in the news for the last 2 or 3 years, often for not the most positive reasons because of issues around cost disclosure and very wide discounts and a slowdown in the private equity cycle. Now, you produced some results last week, and I think you're taking the view that things are looking up for the listed private equity trust sector and the industry overall. Is that correct? I'm not putting words in your mouth, I hope.
Thanks for having me on, Jonathan. And absolutely, I admit that I'm somewhat biased, but I do have a sort of rose-tinted view on private equity as you look ahead. I fundamentally still believe that the investment trust structure is the best structure for particularly smaller investors in terms of private equity. You have that daily liquidity that you don't have elsewhere. You have the track record of these trusts, the evergreen nature of these vehicles. You don't have that J-curve, independent boards, many of them pay dividends. So I think we're at danger sort of the last few years of talking this down. But I actually think it's a terrific structure for the asset class.
We'll come back to the industry overall, but let's just talk about discounts. It was pretty striking that in your case, your discount went out to around, I think, 45% or something compared to the reported NAV, and others obviously have been in very similar positions at its worst. That has been changing, of course, recently, and we have seen significant re-rating in the listed private equity trust sector over the last 12 months. So obviously, there's a lot of talk in the industry about discounts, and we know that SAMA is attacking equity trusts. So do you think that we're at a point now where perhaps discounts are being taken more seriously by boards and managers than they were perhaps a little while ago?
I think definitely. You look at the actions of the various boards across the sector, and that would suggest the case. There's no reason for listed private equity to differ in terms of discount from the private equity secondary market, where private equity firms trade limited partnership positions. And that's currently trading on average in the buyout space around 10 or 12% discount. And you look at the private equity trusts, many are in the 20% or 30% plus. And that, to me, that's a head scratcher. There should be no fundamental reason for such a difference. At the same time, you've seen the semi-liquid structure in private equity really taking off and raising money at a clip. And that's even more confusing. There seems to be a lot of demand for that, where you don't have the same liquidity, but the subdued buying demand for listed private equity. And there has been now for a good 2.5 years. So it's a long time. But I think the boards have done the right thing and they've listened to shareholders. They've gone out there, spoken to shareholders, understanding the issues as the shareholders see them. And you can see a number have introduced enhanced capital allocation policies as a result, which can only be helpful in terms of addressing some of the misconceptions, in terms of narrowing discount, but fundamentally providing cash back to shareholders, providing NAV accretion to shareholders. So I see that as a really positive thing. And in our case, I mean, we've had a dividend for well over a decade. The dividend's increased every year in terms of value for the last 10 years. I mean, it grew 5% last year and 11% the year before. So we've been quite long-term in terms of returning capital to shareholders at NAV. And we also introduced a buyback program, or say the board introduced the buyback program at the start of 2024, and that's been quite helpful. As you say, we did at the lowest point get as wide as sort of mid-40s discount. I think we're around about 27%, which we're not content with. We want to continue to drive that in and be closer to that level that I mentioned earlier where the private equity secondary market is trading. But it's still some way to go, but there's been at least progress in the right direction.
Yeah, I mean, I guess the point that some people will make will be, well, why didn't boards do this before? Or why didn't fund managers do more about it before and introduce these capital allocation policies? A 45% discount, even if it's temporary, is a pretty shocking thing, isn't it, in a way? I mean, it does suggest a certain, well, I was going to say neglect of perhaps shareholder interest.
Well, I can only really speak for our trust. And as I said, we've had that dividend in for a long time. I think we were reasonably quick in terms of putting in a buyback program, which brought that discount in quite quickly. I mean, the fundamental reason for doing a buyback program is less about discount control. It's more kind of adding or giving shareholders value, NAV accretion. So it's been successful on both fronts, actually. I can't speak for others, but perhaps there's somewhat a view that, like COVID, for example, where the discounts went out very wide and then came in very, very quickly, that this sort of wide discount was a temporary thing and would revert pretty quickly. But in actual fact, as I said, it's been 2.5 years. And so that's focused board's attention, I think. And I think you look at some of the capital allocation policies out there, they're very attractive to shareholders. And as private equity activity continues to increase and rebound into 2025, and that's what we're seeing, you're going to see a lot of activity. You're going to see a lot of exits, which means a lot of cash coming back to these trusts and the potential to return some of that cash to shareholders.
Well, we'll come back to that in just a second. Yeah, I just want to finish on this point there. I mean, we got some publicity recently for HarbourVest, for example, which is one of the fund of funds. They're actually having a continuation vote, which I don't think there are other investment trusts in listed private equity which have continuation votes. And as you say, these capital allocation policies have come in. So would we be entitled as shareholders to assume that we're not going back to the period when discounts are allowed to get as wide as 40, 45% without triggering more action from boards? I think it's quite important because I think one of the reasons why listed private equity has struggled a little bit more recently is that people think it's just, well, they don't really care about the shareholders. They just let it drift if the discount stays very wide. The boards and the managers aren't too fussed.
Yeah, I think it's slightly unfair insofar as 45% discounts until the last couple of years haven't been common. I mean, you're talking about the start of COVID and the GFC, and the GFCs, obviously, both of those events are enormous market events. But absolutely, I mean, to have discounts as wide as they've been for the last couple of years is certainly not optimal. And I think these capital allocation policies are some way the sector's attempt to address that. And I think boards will act if, for whatever reason, we go back to that place. But yeah, I mean, it's been a very unusual time for these discounts and really to persist for as long as they have.
That's for sure. And of course, markets do look forward rather than back. That is fair to say. And I'm just looking through your recent NAV total return performance. The last 5 years, you've done 11.7%, 37.9%. That was in the sort of miraculous year of 2021. Then 14.1%. And then it went 5.4%, 2.4% in the last reporting 12-month period. But obviously, of course, the discount has come in, and so the share price total returns have been much more impressive. In fact, they've been double-digit for both the last 2-year reporting periods. So would it be your expectation that we're going to see NAV performance improve over the next 12, 24, 36 months? And if so, what are the reasons for that?
Yeah, so it's multiple fold, and you'd expect me to say, yes, of course, it will improve. But yeah, I think when you look at it, the portfolio return over the last 3 years in local currency for our trust has been pretty similar, has been similar levels, so around that sort of 9 to 11%. And this is in a period of time when private equity activity has been pretty low. And you need activity generally, you need exits, because exits typically occur at a material uplift to NAV. So more exits typically means more tailwind to NAV. And so lower activity in the market, as we've seen for the last 3 years, has not been helpful. But what's been really positive has been the underlying performance of the companies. So I think our top 100 companies, if I remember correctly, which equates to around just shy of 2/3 of our portfolio value, grew last 12 months to 30th of September, 12% top line and 18% in terms of earnings. So the businesses are still performing. It's just exits have been fewer than certainly 2021, which was a record year. That said, the exits we have seen, the natural exits, shall we say, have been at a 26% valuation uplift when compared to the valuation 2 quarters prior. So we're still seeing that uplift. And as we look ahead, private equity activity, it seems to be picking up. So the second half of 2024, we saw a material uplift in deal count and deal value. And just listening to the sentiment in the industry, the credit availability is good. Banks have returned, private credit is still there. The cost of debt is decreasing from both a margin and a base rate point of view. But importantly, the bid-ask spread between buyers and sellers, so this sort of mismatch of like buyer and seller expectations, that seems to be solving itself and narrowing. And the fact is that private equity needs to get to work, both from a buy perspective, because there's over $1 trillion of dry powder in the industry at the moment that needs spent, and a sell perspective. You cannot wait forever to sell your assets because that has negative consequences in terms of your performance. So when exits come, as we expect in 2025, so does cash, obviously, but so does uplifts in value. And so that has the potential to drive NAV. The last thing I would say is that FX also has quite a lot of impact. So if you're quoting our numbers from the last 3 years, as I mentioned earlier, in local currency, the numbers are pretty similar, but sterling's appreciation versus dollar and euro over the last couple of years has suppressed NAV for private equity trusts that typically make investments in dollar and euro. Whereas we're seeing so far in this financial year that the FX is going the other way. So that'll have an impact as well, though that's outside of managers' control.
Some shareholders have been dubious about whether the NAVs are faithfully reflecting the value of the portfolio companies that you have or the direct investors you have and so on. Do you think that that has been an issue, and do you think that the industry's done enough to convince people that the NAVs can be relied on?
It's definitely had an impact, this perception around valuations, because financial publications, some notable ones and very well-read ones, have really led with this. What we find practically is that private equity valuations aren't as correlated with public equity as many would think, and that's both when public equity is moving up and down. The important thing for me is their governance and the managers we partner with. Do they have appropriate governance and robust governance around valuations? Do they have independent valuation committees? Are they reporting in line with private equity guidelines and appropriate accounting standards? Is there proper challenge? Do the auditors challenge, at least on an annual basis? So the governance from certainly the managers we partner with is very strong. But ultimately, the proof is in the pudding when an asset is sold. And what we've seen consistently for some period of time is that assets are sold at an uplift to valuation. Private equity is trying to value businesses at a period of time based on selling typically the majority of the business. So it's pretty hard to comp that against listed equity where it's the price of a marginal share. If you take a business private, the price would be different. So there's a bit of a challenge there, but ultimately what we're seeing in our portfolio is that exits are still at a valuation uplift. As I mentioned earlier, 26% last year, it was 18.5% the year prior, and over the long terms around that 25% mark. So hopefully as we see more exits come through, as we expect over 2025, that will give more comfort around this valuation point.
You are listening to a Moneymakers podcast. We are an independent research and publishing venture, and grateful to JP Morgan Asset Management for their generous, no-strings financial support, which enables us to keep the podcast free and our editorial principles intact. Each podcast episode goes live shortly after being recorded with a weekly catch-up email notification every Saturday afternoon. Why not also try our premium weekly subscription newsletter, which provides a comprehensive summary of all the latest news, results, and performance data from the investment trust sector, with links to the relevant stock exchange announcements, and many other regular features, including more than 160 in-depth trust profiles, regular market commentary and videos, plus the editor's favorite funds. Never miss a thing that might affect your portfolio. So sign up today at money-makers.co. And thank you for listening. So obviously the people who've been out there pushing the shares of listed private equity trust, or promoting them, or advising people to buy them, shall we say, they've focused on a number of things of potential catalysts that could change things. Obviously the most important would be the pickup in activity that you're talking about, exits in particular. But there's also other issues like resolution of cost disclosure and interest rates coming down. As we speak today, in terms of cost disclosure and interest rates coming down, it's not so clear-cut, perhaps as many had hoped, that would be happening now. So what's your thought on those two issues and how they might affect the performance of your trust and others like yours?
Yeah, so we're not really at the moment placing an awful lot of emphasis on, I guess, material interest rate cuts across 2025 when I'm saying that the activity is coming back. Obviously, interest rate cuts are helpful because that lowers the cost of debt. and makes it easier to transact, and it will help with that sort of bid-ask spread in terms of buyers and sellers in the private equity market. But, there's no doubt that interest rate cuts will certainly help there. But I think activity is coming back anyway. And we've seen that from our portfolios, a number of transactions signed at the tail end of 2024 that'll close in 2025. As I mentioned earlier, the sentiment in the industry is very positive for deal making, that credit conditions are as good as they've been really since 2022. So all of those things, that's what gives us the comfort when we're looking at 2025. In terms of cost disclosures, they absolutely hammered trusts like ours in particular, where historically, where you're partnering with other managers, both directly into private companies alongside them, but also through their funds, having to disclose underlying management fees, underlying performance fees in your overall number, just made us look disproportionately expensive, and it frankly was misleading. So I'm hopeful if we get to a solution, a permanent solution where that is rectified, that it will help private equity trusts like ours. Because I think retail investors, for example, going onto the platforms and being given the wrong cost numbers, it's got the ability to dissuade them from investing. And wealth managers as well, if you're having to disclose a very large number to your end clients, that would dissuade you as well from recommending a private equity trust. So I think in terms of the sectors within the investment trust world that stand to benefit from a proper cost disclosure regime, private equity is right up there. But I don't think we've seen any big change on the back of the FCA's forbearance, for example. I think it will take a bit of time for that positive impact to come through.
Just on a sort of technical point there, I'm sure listeners will be interested to know, with regard to the platforms, they're insisting on having a high cost figure coming through the EMT, as it's known. Are you still having to provide that figure because of the state of limbo which you're in? We've got forbearance, but the platforms are still insisting you put through a higher number than you would otherwise have done if you had it your own way.
Yeah, so we've taken the decision to put 0% in our KID because we think that's the right number. And the platforms are, a number of them are our top 10 shareholders. We've chosen to put our ongoing charges ratio number in the EMT, so 1.1%, to make sure that we stay on the platform and our trust is available to retail investors.
Right, it's a pretty crazy world, isn't it, where you have two different numbers for different audiences. It has to be sorted out eventually. So let's move on then and talk about your trust in particular. Obviously, you mentioned the issue around fund of funds and having to add up cost on cost, as it were, for public disclosure. But you're actually changing your strategy, aren't you? You're sort of moving a little bit towards a greater emphasis on primary investments and particularly on direct investments. Have I got that right?
Yeah, so really this trust has been around for over 2 decades. It IPO'd in 2001 and it was known as Standard Life Private Equity. And it has been always focused on private equity funds. Since its inception, it was a pure fund of fund for its first 18 years, give or take. But in 2019, we decided it made sense to introduce direct investments into the investment objective, which are typically co-investments alongside one of our main private equity manager relationships, and occasionally single asset secondaries as well. But the advantage of direct investments is that relative to funds, you're obviously not paying as high fees. And in many cases, you're not paying any fees or carried interest or performance fees at all. And so if you build that diversified portfolio of high quality direct investments, it has the potential to outperform funds. And I would say that we did that. And as a manager, we charge a flat fee. We don't charge a performance fee on top. So assuming we get it right and the performance so far is good, that added advantage will flow through to shareholders in full.
Can you give us an example of the kind of things that you do, the kind of direct investments you're making now that in the past you would have done through a fund of funds method? I mean, how many are there in that category now?
So the financial year end 30th of September, there were 32, and that equated to 26% of portfolio value. We've actually added a couple more since then. We want to get it to a portfolio of around 35, 40 companies and maybe 30% of the book in the short to medium term. In terms of some of the examples, the biggest example, our number one company is Action, and people know that very well. We did hold that through a fund. Then we took our money off the table back in 2019-20 and reinvested half directly. So that's probably, well, it is our largest exposure. But what we're trying to do is more lower mid-market companies. companies with an enterprise value at entry between 100 million and 500 million, where there's a lot of potential for those businesses to grow, a lot of ways a private equity firm can help those businesses accelerate their growth, whether that's digitizing a traditional business, whether that's helping them with buy and build to increase the scale, or to internationalize their product or service offering. These smaller businesses tend to have more avenues for growth than the larger, more institutional businesses in the large cap space. And they're also less reliant on IPO as an exit route, because you can sell into the larger private equity firms as well as trade buyers, or indeed list should you wish. And so some examples of that would be a business called Woundex, which is our second largest business, which is a co-investment we made alongside a German private equity firm called Capiton, and that's performed very well. It basically treats complex wounds outside of the hospital environment and is growing its earnings very strongly indeed. So that's now our second largest. Our third largest is European Camping Group, which is kind of self-explanatory, but runs campsites across France, Italy, Croatia, Spain. And that was kind of our, I'd say bet, I don't like using the word bet, but it's sort of a thesis around the recovery of travel and leisure post-COVID, and that's gone very well, both organically but also inorganically. It recently bought one of its largest peers, Vacances Select in France, so that one's ahead of plan as well. So yeah, I mean, that's a slight flavor of what we do. 3 companies in our direct investment book, but as I say, there's another 30 odd in that portfolio now, well diversified by sector and geography and manager indeed.
So looking forward, how would you expect the performance of your trust, which is, as you say, in the mid-market area, to perform relative to some of your peer group?
Again, I'll say that we will outperform. I've got probably the compliance people there looking at me with steely eyes. But yeah, look, it's very hard to say. I think that, as I mentioned earlier, that the private equity managers that have trusts have got long track records, have performed very well. All I can say is why we're positioning our trust the way we are. And, you know, it's proven that the mid-market and the lower mid-market outperforms the larger end of private equity. And we think that that will be even more pronounced when you look ahead to the next 5-10 years, when interest rates won't be zero. And it'll be less of a free lunch from a financial engineering point of view. So it will be about value creation. It will be about buying businesses where there's more to do with them, that you can grow them more quickly, that you can reinforce management. For example, you don't already have a professional management team. Perhaps it's transitioning a business from being founder-led to having a professional management team. So there's ways that these private equity firms can help these businesses, many more avenues in that sort of mid-market, lower mid-market space than perhaps at the larger end of the market. I would say, though, as we look ahead as well, the increase in direct investment, the fact that we only charge a flat fee, we don't charge a performance fee on top. I mean, those are also relevant factors as we look ahead to performance. So that was very hard to say, and I've got a lot of respect for the other trusts that are in this sector, but I think we've got some nice differentiating points which will help us perform over the short to medium to longer term, frankly.
Well, it's obviously not my job to sing your praises, but I mean, I was looking at some recent broker research that over 5 and 10 years, your trust has actually outperformed the MSCI World Index, which, given all the issues, that's pretty impressive.
Well, thank you very much, Jonathan. No, I mean, I
can you keep it up? That's the question.
But I think it's important, though, that I do feel like we're talking down the private equity trusts quite a lot, and managers and boards have been on the back foot. But whenever I see one of these nice tables that the AIC produces around the best performing trusts, I mean, private equity trusts are right up there and they're prominent in these lists. And if I'm not mistaken, the sector as a whole is the best performing sector over the long term. And so I think we should be careful not to talk these down too much. I think even with the discounts the way that they are, and nobody's happy about that in our sector, the share price total return over the long term has been very good, and we shouldn't rest on our laurels for sure, but it should be noted, I think, that performance.
Finally, then, what are the greatest risks that you actually see here? Because obviously the world of investing is always subject to big events around the world. Mr. Trump, for example, do you think Mr. Trump is a positive for things you're doing? Or do you think the geopolitical tensions are a risk? I mean, there are a lot of risks out there, and the valuations of listed equities are still quite rich in some places. What are the biggest risks that you see out there that might colour this otherwise positive picture that you're painting?
That's a really tough question right now. I mean, as I sit today, there's all these headlines around tariffs. I think for me, a return of inflation, if that bites back and keeps interest rates higher, that's not going to be great for private equity, for sure. And the tariffs have that potential, of course. It's sort of general deglobalization, isn't it? And it's kind of sad to see. And President Trump, don't want to disrespect him, I think in some ways he can be positive for private equity and the outlook for private equity, pro-business, pro-markets. But yeah, the whole tariff point, and bear in mind our trust is roughly 3/4 European, that has the potential to bite. So I think we're keeping a close eye on that. We are micro investors. It's about backing managers and companies, but you obviously do have to have a top-down view. So keeping a very close eye on that. You know, geopolitically as well, some of the conflicts that have gone on and whether some of those situations are exacerbated, that would have negative potential as well. So yeah, I think though we're watching the whole tariff situation very closely. But yeah, as I sort of alluded to earlier, private equity is a long-term asset class. You're making partnerships for 5-10 years. So you've got to kind of make your decisions with that sort of time frame in mind and sort of cut through some of the noise.
It's certainly an uncertain outlook. But anyway, thank you so much for sharing your perspective on all this, Alan. That was Alan Gauld of Patria Private Equity Trust, one of a number of trusts which I've seen their discounts come in a little bit since the lows not so long ago.
Thank you for listening. The Moneymakers Investment Trust podcast is independently produced and edited and is freely available on YouTube, Apple Podcasts, Spotify, and other podcast channels. You can also sign up at money-makers.co to be notified of each new edition. Please note that podcasts are provided for educational purposes only, and nothing you have heard from any speaker should be regarded as constituting investment advice. If you want more news, analysis, interviews, and other investment trust content, don't forget to look at the Moneymakers Circle, available for a modest subscription at the website.